Is your auto loan putting your budget at risk? Analysts warn that more than 3 million vehicles could be repossessed by the end of 2025. Delinquency rates just hit a 30-year high. Today, we break down the Repo Crisis, explain the $6,754 negative equity trap affecting families, and share practical steps to protect your car and your finances. We deal in financial realities here, and the truth is, the auto market is showing serious cracks. If you want to stay ahead of potential repossessions and protect your financial future, hit that subscribe button and turn on notifications. We're analyzing the data that lenders rarely highlight. We are witnessing a silent financial crisis unfolding on American roads. It's not just about losing a set of wheels. It's about losing the ability to get to work, to take kids to school, and to participate in the economy. According to data from Cox Automotive and Bloomberg, repossessions in 2024 surged to 1.7 million, the highest level since the 2008 financial crisis. But 2025 is even worse. Projections from CU Repossessions suggest we could see upwards of 3 million vehicles seized by the end of this year. This isn't just bad luck. It is a systemic failure caused by 5 specific financial traps. We are going to break them down one by one so you can see if you are at risk. Part 1. The subprime delinquency spike. The first sign of the bubble bursting is who is stopping payments first. The data. In October 2025, Fitch Ratings reported that subprime auto loan delinquencies, borrowers with lower credit scores, hit 6.65%. That is the highest rate in 30 years. Even serious delinquencies, people who haven't paid in 90 days, are at levels not seen since 2010. The reality: this is an early warning sign for the broader market. When inflation squeezes the budget, the car payment is often the first thing to slide after rent. But lenders are aggressive. In 2025, technology will allow them to track your car's location or even remotely disable the starter if you miss payments. The window between late and repossessed is shrinking fast. Part 2. The $750 monthly payment trap. Why are people missing payments? Because the payments are astronomically high. According to Experian and Edmunds, the average monthly payment for a new car in 2025 is hovering around $750. For used cars, it's over $529. Interest rates. This is fueled by interest rates that average over 10% for many buyers and can soar past 20% for subprime borrowers. The squeeze. A $750 car payment rivals a mortgage for many households. When you combine this with rising insurance premiums and repair costs, the total cost of ownership for a standard sedan can easily exceed $1,100 a month. That creates serious strain for households earning $60,000 to $70,000 annually. We've just covered record high payments and 30-year delinquency highs. If this data is helping you understand the market, please hit that like button. It helps us spread this warning to more drivers before it's too late. Part 3. The underwater epidemic, or negative equity. This is the most dangerous trap of all. It's called negative equity, or being underwater. This happens when you owe more on the car than the car is actually worth. The data. A stunning report from Edmunds in late 2025 revealed that 26.6% of all trade-ins now have negative equity. The cost is nearly $6,754. The rollover trap. Millions of Americans are trading in cars they still owe money on. They take that $7,000 deficit and roll it into the new loan. Now they are paying interest on the new car plus the old car. The reality is that this creates a growing debt cycle that is very difficult to escape. If you wreck that car or lose your job, you can't even sell it to pay off the loan because you owe $7,000 more than a buyer will give you. You are trapped. Part 4. The pandemic price correction. Why is negative equity so bad right now? Because of what happened in 2020 to 2022. The context. During the pandemic supply chain shortage, car prices skyrocketed. People paid $5,000 or $10,000 over MSRP just to get a vehicle. The crash. Now in 2025, supply is back and used car prices have normalized or dropped. The result? If you bought a Toyota Camry for $35,000 in 2022, that's normally worth $25,000, and now it's worth $18,000, that massive depreciation gap is yours to pay. You essentially overpaid for an asset that has crashed in value, and the bank still wants their money. This pandemic premium is the primary driver of the repossession surge today. Part 5. How to protect your ride. The escape plan. If you are struggling, you cannot hide. You need a proactive plan. Communicate early. Do not ghost your lender. Call them before you miss a payment. Many lenders have hardship programs that can defer payments for 30 to 60 days. They don't want your car. They want your money. Sell the car if you can. If you are not underwater, sell the car immediately and buy a beater with cash. Eliminate the payment entirely. Refinance. If your credit score has improved since you bought the car, check with a local credit union. You might be able to drop your rate from 14% to 8%, saving hundreds a month. Voluntary surrender. As a last resort, if you cannot pay, consider a voluntary surrender. It still hurts your credit, but you avoid towing costs and reduce the stress of repossession, which lenders may carry out quickly. The 2025 repo crisis is real. Delinquencies are at a 30-year high. Payments average a crushing $750 a month. Negative equity averages $7,000 per trade-in. Pandemic loans are haunting borrowers, but communication and action can save you. Take proactive steps so your car doesn't become part of these growing numbers. Treat your auto loan as a serious financial threat and manage it aggressively. I'm curious to hear from you. Have you noticed more repos in your neighborhood or town lately? What is the highest monthly car payment you've heard of someone paying? Drop your answers in the comments and subscribe for more educational content on personal finance. Thanks for watching.